Franklin India Dynamic Asset Allocation Fund of Funds. Investment behavior is typically guided by two emotions, greed and fear. Basis whether you make a gain or a loss, these emotions can have an impact on the investment outcomes under four different scenarios. 1. When there is fear of losing money. 2. When there is fear of not making as much money as other people. 3. When you are greedy to keep the money you have. And 4. When you are greedy to make more money. It is observed that investors are irrationally influenced by these emotions and hence end up taking wrong investment decisions. Under the influence of greed and fear, the biggest mistake investors make is to try and time the market. In an ideal scenario, investors prefer to buy at the lowest point and sell at the highest point. However, timing the market to match these points is very tough. Further, getting this wrong can also impact the power of compounding and, in turn, hamper wealth creation in the long run. So, what should an investor do? The answer is to diversify. Diversification refers to spreading your investment in different asset classes and investment instruments. One can diversify across asset classes like equity, debt, and gold, besides geographies. Diversification helps to reduce risk in your portfolio. There are two ways in which investors can diversify across asset classes when they invest through mutual funds. 1. Choose and invest in individual funds in the proportion of asset classes matching one's risk appetite. For example, higher equity allocation if one has a higher risk appetite. Or 2. Invest in a mutual fund which offers a combination of asset classes in a single fund. For example, a single fund which invests 60% of the money in equity assets and 40% of the money in debt assets or vice versa. Such funds are called hybrid funds. Hybrid funds offer a ready-made diversified asset allocation combination to investors, thus avoiding the hassles of investing in individual asset classes on their own. Hybrid funds come in two variants. 1. A portfolio of stocks or securities across stated asset classes in a predefined proportion of asset classes. And 2. A fund of fund product where each fund represents an asset class and is held in a stated proportion. Why invest in hybrid funds? Hybrid funds provide a ready-made diversified portfolio across asset classes. Diversification helps lower risk in a portfolio as no two asset classes generally move up or down at the same time. And this, in turn, aims to provide higher risk-adjusted returns. Asset allocation in a hybrid mutual fund is as per the mandate mentioned in the offer document. And one can allocate across equity and debt mutual funds manually, but this requires investors to regularly monitor the allocation and rebalance it periodically to the original asset allocation. For example, if the asset allocation was a 60-40 debt-equity mix and changes to 70-30 after 1 year due to market movement, one needs to sell debt or buy more of equity to bring the ratio back to 60-40. This is called rebalancing. While rebalancing across individual mutual funds, it is also important to check for exit loads and tax implications in case of redemptions. However, in case of hybrid funds, there is no impact of exit load and tax when the fund manager rebalances the allocation. Hybrid funds offer an asset allocation combination wherein one can either choose a static or range-bound asset allocation or a dynamic or a variable asset allocation, which uses a formula or strategy, like say price to earning, PE ratio, and or price to book value, PB ratio, to allocate across asset classes. These funds swing between an equity orientation to a debt orientation depending upon the formula. Key benefits of investing in this fund. This is a fund of funds scheme which invests in funds from within the Franklin Templeton basket of funds. Through this structure, it provides strategic allocation to both equity and debt asset classes. The equity component is invested in Franklin India Equity Fund or Franklin India Blue Chip Fund. The debt component is invested in Franklin India Short-Term Income Plan or Franklin India Low Duration Fund. It has a unique inbuilt buy-sell discipline based on market valuations, which gives less room for subjectivity or any error of judgment. The fund has a predefined monthly rebalancing mechanism based on two factors, namely PE and PB level of the Nifty 500 index. It reduces equity exposure and increases debt exposure when PE and PB levels are high and vice versa. This fund is suitable for those who are not only keen to take advantage of the growth opportunities in equities, but also prefer to reduce the impact of market volatility. What is PE and PB ratio? PE stands for price earning. This price earning ratio is the price of a share for every rupee earned by the company. The latter is the profit after tax or PAT per share. For example, a company with a stock price of rupees 60 and earnings per share of rupees 3 will have a PE ratio of 60 divided by 3 equal to 20. On the other hand, PB ratio is price to book value ratio and compares the market value and book value of the company. Book value per share indicates a firm's net asset value, which is the difference between total assets and total liabilities on a per share basis. For example, a company with a stock price of rupees 50 and book value per share of rupees 25 will have a PB ratio of 50 divided by 25 equal to 2. Just as it is always good to buy a stock at a lower price and sell at a higher price, this rule also applies to PE and PB ratio, which are used as a trigger to increase or decrease equity exposure. Accordingly, one can increase equity exposure when the PE and PB ratio are low and reduce exposure when both the ratios are high. Buying more equity when the PE and PB ratios are low helps to gain when the market rises, and reducing exposure when both the ratios are high helps to cushion the fall when the market peaks. The PE and PB ratio are thus an easy and objective method of allocating between equity and debt during market cycles. Now that we know how a PE and PB ratio works, let's understand how they are used in the Franklin India Dynamic Asset Allocation Fund of Funds. The fund has a predefined equity allocation corresponding to PE and PB ratio of Nifty 500 index. The fund manager decides the equity allocation percentage corresponding to these predefined range, and the resultant equity allocation will be as per the average of both PE and PB. Let us understand this with an illustration. Let's say PE of the index is 16 and PB is 3. Then, as the predefined range, the PE equity allocation is between 67.5 to 80% and PB equity allocation is between 63 to 80%. Assuming the fund manager considers equity allocation of 67.5% for PE and 63% for PB, The overall equity allocation will be the average of 67.5% and 63%, that is 65.25%. Ideal investment horizon. Since the investment in equity funds can swing between 20 to 85% range based on the PE and PB ratio, the fund can be a predominantly equity-oriented fund or a predominantly debt-oriented fund basis the allocation. Hence, we recommend a longer investment horizon of 5 years or more, which suits both equity and debt-oriented fund. Equity funds tend to display volatility over shorter time periods, but when one invests for longer periods of time, that volatility factor tends to get negated. Every investment you make must ideally be linked to a financial goal, and this goal could be of varied durations depending upon your investment needs. Since the fund is recommended for an investment horizon of 5 years or more, it is ideally suited for planning your long-term financial goals, such as your child's higher education, marriage besides building a retirement corpus, or even seeking long-term wealth creation. Who should invest in this fund? Those with a moderately high risk profile. Those looking for a ready-made diversification across key asset classes. Also those who want equity growth and seek to cushion market volatility with a debt exposure. This fund helps to invest across key asset classes like equity and debt through a single fund which automatically allocates among these components using the PE and PB ratio formula. Let's take a look at the tax structure. Liquidity. You can redeem your investments in full or in part on any business day. The redemption amount is normally dispatched within 10 working days from the date of redemption. You could either receive this amount as direct credit into your registered bank account or as a physical check which you can deposit in your bank account. Let's get to know some fund facts of the Franklin India Dynamic Asset Allocation Fund of Funds. For more information, please feel free to contact your mutual fund distributor or registered mutual fund advisor, or log on to www.franklintempletonindia.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.